Hi there, I'm Anthony Zaman, Wealth Partner at Cooee Wealth Partners. Today I'm joined with Andrew Grinsell, Wealth Partner and member of Cooee's Investment Committee to discuss recent performance of investment markets and what to expect in the year ahead. So I'll kick it off with a couple of questions. So Andrew, since the start of 2022, there has been increased volatility in Australian and international equities. What are the main reasons for this?
The biggest issue that markets are facing right now is inflation. What we know is that markets don't like uncertainty. And in recent months, the market's been trying to understand when the US Federal Reserve and other major central banks will start to raise interest rates. In addition to inflation, there's also ongoing effects from the pandemic and growing geopolitical tensions between Russia, the Ukraine, and Western powers.
Okay, and can you tell me how this has impacted investment markets?
Yeah, so we've seen growth stocks and cryptocurrencies as the biggest casualties during this time. The NASDAQ 100 index, which has a really strong focus on technology stocks, fell by 8.5% in the month of January, compared to a much smaller fall of about 3.2% for the more diversified S&P 500 index. More traditional defensive assets weren't immune from the sell-off, with the most widely recognised index for Australian fixed income investments also slipping by about 1% during January.
Right, okay. And what can we expect in terms of interest rate rises here, and what impact might this have?
Yeah, so because we're investors in global markets, we need to also be aware of what's happening overseas in addition to Australia. So it's quite a high possibility that the US Federal Reserve will start to raise interest rates up to about 0.5% as soon as June 2022 and exceeding 1% by the end of the year. Back home, the market's pricing in the first interest rate rise of about 0.25% to occur around July this year, with a few interest rate rises to follow on thereafter. So businesses that have higher levels of debt or lower levels of free cash flow are going to be most impacted by these rate rises, which is why we've seen the tech companies suffer higher losses during January.
Okay, and then so how should clients be investing in the current environment?
So first and foremost, investors need to clearly define their overall financial strategy and implement a portfolio that complements their broader strategy. Investors with a long-term investment timeframe and greater tolerance for risk shouldn't see the short-term volatility as a major concern. High exposure to growth assets such as shares will remain suitable for those investors. However, investors who are now reliant on their portfolios for meeting their living expenses will need to keep a portion of their portfolios invested in lower risk assets to reduce the risk of needing to sell at a loss. The volatility we've seen in markets since the start of 2022 is nothing new. It's important to avoid acting with emotion and really focus on the fundamentals. We often see quality investments get oversold during these kind of environments, which can actually provide an opportunity for investors who do take that logical long-term approach.
Okay, and how has Cooee's investment committee positioned its model portfolios in that case?
So our actively managed model portfolios have held a bias towards high-quality international companies like Microsoft, Johnson & Johnson, Nestle and Coca-Cola, rather than the more speculative growth stocks that are likely to come under pressure as interest rates increase, which puts an increase on these businesses' expenses and their ability to borrow. Domestically, our clients are invested in the large diversified mining companies, consumer staples and other mature businesses that tend to have a lower level of debt and higher levels of free cash flow than those more speculative growth companies. Moving on to fixed income or the defensive side of the portfolio, we have certainly preferred to have investments that have a shorter investment time frame until maturity. This avoids locking in low rates for a long time frame. We're also looking at investments where the interest paid to investors increases as interest rates rise. Finally, we've added positions in gold and other alternative assets that should help reduce overall portfolio volatility.
Fantastic. Well, thank you very much, Andrew. That explanation really helps on what's currently driving markets and how investors should respond. I think the key takeaways from this conversation is that investors should be making decisions that align to their overall financial strategy and act on fundamentals rather than emotion moving forward.
Excellent. Thanks, Anthony.
Thank you very much.